Okay, class, we're gonna take a look at problem 23-29A, okay? And they want us to compute variances. A few things you want to point out. This company makes coffee mugs, and they have a static budget volume of 59,800. And then we're given some other data. We're given the standard unit amounts, and we're given what actually happened. Okay. So the first two variances will be cost variances, and we're going to be doing them for both material and labor. As you know, with cost variances, we want to analyze the difference in costs. So we're going to isolate that difference in costs by getting the difference between actual cost and standard costs, and we will hold actual quantity constant. Okay. So for direct material, the actual cost per unit was 17 cents per pound. And up here in the table on the left, the standard is 25 cents. So we have an 8-cent difference. If we take that 8 cents and multiply it by the pounds used, 10,000, we come up with $800. Now, because our actual 17 cents is less than the standard, we could say that we're under budget, and that's favorable. Okay, so we have an $800 favorable effect from cost in our overall materials variance. Okay. Now, direct labor cost variance, we would take a look at the differences in the labor. Now, they're giving us the actual labor. Actual direct labor usage was 198,000 minutes. So if we take those 198,000 minutes and multiply it by the standard, 10 cents per minute, we get 19,800. That would be the standard. Actual direct labor, which is actual cost times actual quantity, was 25,740. So our actual is higher than what the standard is. Okay, so we'll get the difference. And because the actual is higher by 59,040, we have an unfavorable variance. Alright. Okay, plugging along. Now we're tasked with doing the efficiency variance. So with the efficiency variance, we want to isolate the change in quantity and hold the costs constant. So we're going to go actual quantity minus standard quantity times standard cost. Okay. So for material, the actual quantity was 10,000 pounds. Our standard for 62,500 coffee mugs here on line item B. So the standard says that we should be using 0.2, 1/5 of a pound per coffee mug. So 12,500. So it looks like the standard of 12,500 is higher than what the company actually used. They actually used 10,000 pounds. Okay. And it's higher by 2,500. So we'll take that difference of 2,500 and multiply it by the standard cost of 25 cents per pound. So 625, and again, because the standard was higher than the actual, we have a favorable variance. Okay, and we're going to use the same logic with labor. Let's see here. So actual quantity of labor was 198,000 minutes. The standard says that we should be using 3 minutes per mug. So we'll take 3 minutes times 62,500 mugs. So I got 187,500. So the standard is less than the actual of 198,000. Our standard is 187,500. So the difference between the two is 10,500, and if we multiply that times the standard rate of 10 cents per minute, we get 1050, and again that's unfavorable because we used 198,000 minutes when we should have only used 187,500, which is 3 minutes times the number of mugs made. Okay. Now we're required to make a journal entry to show the purchase of the raw material. So let's see. When you buy raw material, it will go into the raw materials inventory account, and you'd either pay cash or do it on account. There's no cash account, so we're going to be doing accounts payable, and this will be for the purchase of direct material or raw material. Okay, and then let's see, we have a direct material cost variance, a favorable variance. So favorable variances are credits of 800. You can plug that in from your first table up there. Direct material cost variance, favorable. And then we're going to put in the purchase information. Okay, so if we bought 10,000 pounds, notice in A it says that there was no beginning or ending inventory and all expenditures were on account. So we must have bought 10,000 pounds. So if we bought 10,000 pounds and the standard says 25 cents per pound, so we would book the standard to our inventory account. And then remember, we actually paid 17 cents per pound. So if you took 10,000 times what we actually paid, that's going to end up being what's charged to accounts payable. So 1,700. Now these two should check out. 2,500 and 800 plus 17, 1,700 should be 2,500. So our entry appears to be in balance. Okay. Now same logic with labor. Oh wait a minute, we're not going to labor. We're going to do the efficiency variance on material. So we're going to take care of this efficiency variance, and that's favorable as well. So you could go ahead and plug that in, 625. It's going to be a credit because it's favorable. And this would be your direct materials efficiency variance. Okay. Now remember, when we move material into production, we're going to put it into the work in process account and take it out of the raw materials account. So that it would be a debit to work in process and a credit to raw materials. And let's see, use direct materials. That's what's happening. We're moving it into production. Okay. So if you think about it, what's the standard for 62,500 coffee mugs, right? And if we, if we went with excuse me here. Right, we want to isolate quantity. So the actual quantity was 10,000 pounds, and we used, our standard was, I'll recompute that standard for you, 62,500 times 0.2. So, oops. Standard was 12,500, so the difference is 2,500, and we're going to book that standard in at standard costs. actual, right, 62,500. Okay, there you go. So what I did was I took the standard quantity, and it's, if you could work the journal entries at the same time you're doing your variances, but since we did the variances and the entries separately, we almost have to work the variances again. I took the standard to get this debit to work in process. The standard is 2 pounds per mug, so 0.2 pounds per mug times 62,500 mugs times 25 cents. Okay, 3,125. You could just take 5 cents times the number of mugs. They already extended that value out for you here, 5 cents, but to show you the long way. And then for the actual, which is what's actually being moved out of raw materials, I just took the 10,000 pounds times the standard cost of 25 cents per pound. Okay, so remember, that's playing off of this direct material efficiency variance, where we're actually applying the standard cost to both actual quantity and standard quantity. Okay. And then you want to check, make sure this balances. You have your variance, so 2,500 plus 625 should be 3,125, and we'll hit check answer. Okay, good job. Okay, now they want us to lump the whole. So we're not going to break the labor into 2 entries. We're going to do the whole thing in 1 entry. So why don't we look at our variances first? You got direct labor, cost variance unfavorable. So that's going to be a debit, 59.40. And you got direct labor efficiency variance unfavorable, 1,050. Okay. So we can put them in already, right? Direct labor costs, direct labor efficiency. Okay, and then what happens? Well, when you work in a manufacturing environment, the labor gets charged to the work in process account. And what gets credited? Well, you're either going to pay it out, and in most cases there'll be a wages payable account. So the wages payable is going to be the actual number, or the actual amount we paid. So they tell that to me over here in C, 25,740. That's the actual. Let's see, completed. Direct labor cost incurred. Okay, and then what actually gets charged to work in process? Simplest way would be just to take this wages payable amount and subtract the variances from it. So maybe we'll do that. Let's see. Minus. And we'll drop that number in for now, and that would be the standard. But maybe we can take a look. Let's see. What's the standard? Well, if you got 62,500 coffee mugs, and your direct labor is slated at a standard of 30 cents per mug, we could multiply that times 30 cents and see if that 18,750, that checks out. So 2 ways to get to it, and you could check it out that way. Okay, so again, I took the actual mugs times the standard labor rate per mug, not per minute, but per mug. Okay, and the way they got the labor rate per minute is they multiplied the standard minutes times the standard rate per minute. Okay, let's see what we got. Oh, great. Okay. Now we're going to get into some overhead variances. So we'll move some things up and around here. The first one is the variable overhead cost variance. Okay, so to compute the variable overhead cost variance, you'll take the actual variable overhead and subtract the standard cost minus actual quantity. That's your formula. Then to get the variable overhead efficiency variance, you'll take the actual quantity minus the standard quantity, okay, and multiply it by the standard cost. So you have your formulas in there. Now you can start thinking, what was the actual variable overhead? It's sitting over here in letter E, 10,890. So you have that handy. And then let's think about the standard cost for variable overhead is 6 cents per minute. Okay, so you're going to take that 6 cents per minute and multiply it by the actual minutes, the actual direct labor, so 198,000. Okay. Right? Standard cost times actual quantity. And that number is going to be subtracted from the actual variable manufacturing overhead. So remember, the actual is 10,890. So it looks like we're going to have a favorable situation because the actual is less than what we're comparing to. Okay, so let's do that math. Minus 10,890. So we got 990. Okay. Now we're going to go actual quantity for variable efficiency variance, actual quantity minus standard quantity. So let's see. Actual quantity is 198,000 minutes, and the standard quantity for variable is 3 minutes per mug. So 3 times 62,500 mugs. So the standard is 187,500. The actual is 198. So that's going to be unfavorable because the actual is more than the standard. Okay, so if we take the difference between the actual of 187,500 and, I'm sorry, the standard of 187,500 and the actual of 198,000, okay, 10,500, and then we're going to multiply that by the standard cost, which is 6 cents per minute. Okay, so you got 630 unfavorable. We'll see how those check out. Okay, we got a nice work on that. So far, so good. Remember your formulas. Okay, now we're going to do the fixed overhead cost variance, which is actual fixed overhead minus budgeted fixed overhead. Okay. And then we're going to do the fixed overhead volume variance, which is budgeted fixed overhead minus what was allocated. Okay. So let's start with the first one. Actual fixed overhead is sitting right here. We don't have to do any math. Down in letter E, 29,910. And then the budgeted is going to be based on the static budget. So if you come up to the first 1, 2, 3 sentences up here at the top, 59,800. So we'll take 59,800. This is the budget minus, oh, I'm sorry, clear that. 59,800 times, right, our standard for fixed overhead is 39 cents, right? The extended standard, 39 cents. So that would be our budgeted overhead. So our budgeted of 23,322 budget is less than the actual. So we're going to have an unfavorable variance. Okay? And the actual is 29,910. So let's get the difference. 29,910. So we got a 6,588 unfavorable fixed overhead cost variance. Okay? And then finally, we should have kept that budgeted figure, but we'll do it again, right? Fixed budget 39 cents, 0.39 times the static volume up here at the top, 59,800. Keep that handy. we're going to take that budgeted figure, I'm going to put that in memory, and we're going to subtract the allocated amount. So how much was allocated? Okay, that's the question here. How much fixed overhead was allocated to the to work in process? And we can come over here and take a look. Let's see. So we did you know, we may have made a mistake in the first one. Let's go back and redo that first one. We took that 39 cents. No, that's fine. Okay. Leave it at that. Now let's do our budget again. So 59,800 times 39 cents. Okay. That's the budgeted amount. Then the allocated amount would be the 39 cents times the actual mugs, so 62,500. So we'll go 62,500 times 39 cents. That's allocating fixed overhead. So 24,375. Now I'll remember that, 24,375. Okay. And our budgeted was 23,322. So again, we have a difference of 1053. Okay. And we can call that one favorable. Let's see. Yeah, we'll call that one favorable. Okay. So let's see. We need to make some journal entries. And the first one is begin by journalizing the entry to show the actual manufacturing overhead incurred. So I think they tell that to us, right? See, E is actual. So we're going to debit manufacturing overhead and credit. Usually it's all these different overhead accounts, but they just use various accounts. Okay, so this is to record manufacturing overhead cost incurred. So what you would do is you would add the variable and fixed on line item E. So 10,890 plus 29,910, 40,800. Okay. Then they want you to record the amount that was applied or allocated. So you're going to be putting it into work in process and taking it out of overhead. So this is going to be your manufacturing overhead allocated. So you would take your 62,500 mugs and multiply it by, and I believe it was 39 cents, right? I'm sorry, 57 cents total. Okay, because that's variable and fixed. Okay, so we're going to go 57 cents. That's the amount that was allocated. Think about it real quick now, right? So okay. Then finally, they want you to move everything out of work in process and put it into finished goods. That's when things get finished in work in process. They're moved from work in process to finished goods. So we will debit finished goods and credit work in process. And this will be to show the completed goods, right? Completed goods are transferred. So all that really entails is adding everything up that was debited to work in process. So you can start and go back up vertically. The allocation here was $35,625 from the prior entry. And if you scroll up, the labor entry, you booked $18,750. Oops. Make sure you hit the plus sign, $18,750. And in the materials entry, you booked $3,125. I don't know if I hit the plus sign more than once, but we'll try. $57,500. Okay, so that's everything that was in work in process. Now it's being moved out into finished goods. Okay, nice work. And then they want me to journalize the adjusting or the manufacturing overhead account, right? So we need to make an adjustment. Okay, so we need to wipe out these variances that we came up with. Okay, so remember the unfavorables, we'll debit the unfavorables and we will credit the favorables. So not necessarily wiping them out, but getting it on record. Okay, so let's start with the favorable, the unfavorables, right? So variable overhead efficiency variance 630. And probably take your time because let's find another unfavorable. Okay, fixed overhead volume variance. No, I'm sorry, fixed overhead cost variance. Fixed overhead cost variance. I think it was 6588. That was unfavorable. Fixed overhead cost variance 6588. Okay, now we can go to the favorables. Fixed overhead or variable overhead cost variance 990. And variable or fixed overhead volume variance 1053. Let's go fixed overhead volume variance. Okay. And then the adjustment will be made to the manufacturing overhead account. So you get the difference between the debits and the credits, and you will either book a debit or credit to manufacturing overhead. So let's see, I think our debits are more, and I'll get the difference. Make sure you clear your calculator. Let's see. Minus 990 minus 1053. Okay. So the difference is 5175 credit, and you would credit manufacturing overhead. And this is to adjust the manufacturing overhead account. Let's see if our math is right. Yep, we got it correct. Okay. Now the conceptual part. Let's see. Judah intentionally hired more highly skilled workers during July. How did this decision affect the cost variances? Overall, was the decision wise? Hiring more skilled, high-paid labor led to, then you can come back up here and look. Your direct labor cost variance was unfavorable. Okay. To an unfavorable direct labor cost variance, given the direct labor efficiency variance was unfavorable, or the unfavorable direct labor efficiency variance, it does not appear that these more skilled workers performed efficiently. Alright. Overall, the net effect is unfavorable, thus management's decision was unwise. Alright, we got it.